Let's get some ideas for your portfolio. We're into the 10th day of a U.S. government shutdown. Gold has topped $4,000 an ounce this week. We're joined by Bipan Rai, Managing Director and Head of ETF and Alternative Strategy at BMO Global Asset Management. Bipan, always great to see you. Thanks for joining us.
Thank you for having me.
Talk to us about the economy, particularly south of the border. You think outside of this massive investment in AI and data centers, the economy in the U.S. economy is showing signs of slowing?
We do. I mean, if you look at, even stepping back a little bit and looking at the employment backdrop, I mean, we've seen a noticeable slowdown in the amount of jobs that have been really added to the economy over the past several months. To us, that's just consistent with a slowing economic backdrop. But, in our sort of Q4 portfolio strategy report, we made reference to this invisible engine that could potentially be offsetting that drag. And that is in the form of artificial intelligence, either by capital expenditures, by several different U.S. companies that are in the tech space. And then correspondingly, that could be driving wealth-driven net consumption as well, more broadly.
At BMO, generally, you believe in the AI story. You do see this massive expenditures continuing?
We do, at least for the next quarter or two. I mean, certainly there's signs of potentially capital inefficiency. I mean, we could see that by judging the capex to sales ratio. If we look at the Mag 7 plus maybe Oracle and Broadcom as well, we could see that ratio continuing to trend higher. And that at the margin is a worrying sign because it does at least portend to the possibility that investments in capex aren't reaping the same rates of return that they might have in the past. And that's really, to us, the key to watch for over the next a year or so as to whether or not this spending boom in the AI space is going to continue from a couple of firms in the tech space in the U.S. But to us, that's probably a mid-2026 story. Before then, I mean, we still think that the next quarter or two is still going to result in robust earnings.
Talk to us about gold. You're in the camp that says we're seeing generalist investors, institutions taking gold much more seriously.
Yeah, and one way we can gauge that is by looking at ETF holdings of gold and the way they've moved over the past couple of years. So what's interesting is that ETF holdings of gold really peaked around the time of 2020, so close to the end of the pandemic. And then since then, we've seen that move lower. And really, it's been central banks have been doing most of the buying when it comes to gold. But over the last, let's call it 6 months or so, we've seen total known ETF holdings start to increase as well, alongside potentially central bank demand. So that tells us a few interesting things. It tells us that there's a certain degree of FOMO, or at least retail and institutional interest in gold, where previously over the last couple of years there hasn't really been as much. So, do we think that gold can continue to rally from here? Yes. Do we think that in the near term there is a tactical pullback to potentially take advantage of? Also, yes. And we're targeting a price level of around 4,500 by the midpoint next year. And, the options market tends to think that's a possibility as well. So, again, the possibility of gold reaching 4,500 by the midpoint of next year, the market is telling us that's just over 50%. So it's close to even odds. We think that's more than fair at this point.
Wow, that's going to mean spectacular cash flow for the gold miners.
Feels that way, and they've done extremely well so far this year as well. It does feel like this is a space that could continue, and there's several different reasons. It's not necessarily pinned on one or two that we're watching. There's certainly a degree of, call it diversification interest. Really, we look at the fixed income space, we're not as constructive as we have been in years past, and it certainly feels like gold is helping to fill that void as a diversifier in portfolios, whereas before, traditionally it was fixed income more broadly.
You have some trades that you've been making in your ideal portfolios. One is moving money into U.S. utilities, and one play, obviously it's a BMO ETF, is the BMO Spider Utilities Select Sector. And one of the reasons here is to capitalize in what you think will be growth in power generation south of the border.
We think so, and we've seen that theme play out to a certain degree. I mean, don't forget that if we're talking about playing off this AI theme for at least another quarter or two, utilities are set up to take advantage of that, given the heavy degree of investment in data centers, which do involve several utility firms as well. So again, this is a theme that we think still has a bit of runway to go. The other reason as well is if we look at the broader economic backdrop, and we spoke a bit about this earlier about the non-AI related parts of the U.S. economy potentially slowing down. I mean, generally, that's consistent with periods or in the economic cycle where we have defensive sectors start to outperform, including utilities, and now increasingly healthcare as well. So again, to us, it makes sense to take a sort of barbell approach and utilize some of those defensive sectors like utilities with something that still is fairly pro-cyclical as well, including potentially tech and communications.
In Canada, you've switched some money out of the BMO ZLB, the BMO Low Volatility Canadian Equity ETF, and you've gone into what I guess is a broader play, ZCN, which is a capped play on the TSX Composite. You don't want to get too exposed to any one stock, in other words.
Exactly. And then the other item to pay attention to there is the fact that, via the greater exposure to the more diversified market, we get better access to, mining, the material sector, which has really done well in Canada over the past 12 months. And that's something that we just didn't get in the low vol sort of call it indexing for the Canadian market. So that's the reason why we made that particular switch, is really that diversification plus exposure to materials, which we think is better placed going forward.
Just going global for a second, what is your view on the US dollar? I know it's part of the gold story here. People worried about the unpredictability in Washington. Do you see the US dollar weakening? It hasn't had a great year against world currencies.
It hasn't. But it's also, important to take stock of what we've seen over the last couple of weeks, including the fact that if you look at what the markets are pricing in for the Federal Reserve, it does seem overly aggressive relative to what we think is realistic. I mean, yes, the Fed's next move is going to be another 25 basis point cut. I think we can all agree on that. But, will they go at the same speed and pace that the market is pricing in? Probably not, especially since we know that core inflation is a little bit too sticky for comfort for a lot of Fed voters at this point. And what that means is that if the market corrects, we should see some of that pass through to a stronger US dollar in the near term. So again, could we see the US dollar rally in the near term additionally from here? Possibly. But over the medium to long term, we still think the structural arguments for a weaker dollar still remain sound. And a lot of that has to do with the fact that you probably won't get as much, let's call it portfolio recycling of investments outside the United States into the United States. We think there's going to be more room for allocation towards other foreign markets instead.
Bipan, thanks very much as ever. Bipan Rai joining us there, kicking off Friday for us, Managing Director, Head of ETF and Alternative Strategy at BMO Global Asset Management.